Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm. I'll be your host, and today I'm joined with Doug Agron. Hey, Doug.
Hey, Kirk. Merry Christmas, Happy Kwanzaa and Hanukkah, and hey, Festivus for the rest of us.
Happy Festivus, Doug. One of my favorite holidays.
That's right. Do you have your poll ready to go?
Yes, I got my aluminum pole, and I'm ready for the feats of strength.
Okay. Yep. You gotta and make sure you meatloaf or spaghetti and red sauce. No, for your dinner, your meatloaf dinner. Build it. Get your list of grievances. There's also you gotta plan for that Festivus miracle that will that should occur for you. And of course, last but not least, make sure you make your contribution to the Human Fund.
The human fund. Yeah, I'll tell you. Tis the season for the airing of grievances. I feel like that's all year long, though, Doug.
Well, I mean,
people do nowadays.
listen, maybe Elon Musk made a mistake changing Twitter to X. Maybe he should have renamed it Festivus, because isn't that what X basically is a 365-day celebration of Festivus?
I mean, that's social media, period. It's
Right.
just a way for people to air their grievances on everything. But
In a way, though, Kirk, isn't that just a perfect testament to society, right? Think about it. Like, I was just talking to my wife the other day, like when she was young, Christmas was the time in which that was when you generally got like the nice present, or like maybe that was when you got clothes, a good, went out and your parents got you some nice clothes, and maybe that was when you got some brand name stuff, things like that. It wasn't, it was something where there were these times during the year, or these moments in which you kind of went above and beyond and spoiled the ones around you that you loved, or you maybe made an investment, or you got a little bit more. Now it's 365 days. Like, anything you want is at your fingertips. It's an Amazon click away. And I think that's just kind of the testament of social media, right? It's like a Festivus was, it wasn't 20 years ago. I'm thinking about it. Yeah, 20 years ago, about 20, almost 30 years ago now with Seinfeld, right? It's crazy that they would talk about one, they made a joke about one holiday of the year where you could air your grievances, which again was like waiting and having the patience for these opportunities or these moments, which now, fast forward 30 years, everybody wants what they want and demands what they get now. Anything, a point click away. So what is social media? It's just a prime example of that. Instead of waiting once a year for all of your grievances, you can now have your grievances whenever you want them, anytime, on demand. That's just very interesting.
Life.
It's just a total shift of society. Like we have no gratitude for the things that you have to work for anymore.
Well, as is life, Doug. You have everything on demand now, and people don't appreciate the nuance of holding off. But let's. This is the Christmas week, and so let's keep things on the up and up here. It is 2 weeks left of the year, and one of those weeks is definitely Santa Claus Rally Week. But we have Christmas here on Thursday, so you got another few days, and we're getting the end of the year. It's crazy. Christmas just kind of like popped up. I feel like it just happened, and I was expecting it to be to take a little longer. But anyway, as you get older, the time speeds up, or at least relatively. So we wanted to talk a little bit this as we wrap up the year, some perspectives. And also just kind of talk through, I think probably next week we'll be talking through, in the next week or two, we'll be talking through like year end, how things did, and prospectively what you should be looking at for next year. But I do want to say this, that now is a great time to have certain, we'll call it investing hygiene. as you look at the end of the year, now's a great time to assess how your portfolios did this year. Now, all of you are probably really excited to do that because the markets were pretty good this year. And if you followed some of the stuff we said with precious metals, you're doing great this year. But regardless, you should do this in bad times too. But in good times, it's even more important. And here's why. Depending on how you did with your portfolio, you're probably looking at the markets and thinking, oh, I'm an expert. I'm a rock star. I'm really smart. Well, no, you're not. You're really lucky. The reality is that when people look at their portfolios, they think it's a reflection of how smart they are. It's basically an ego trip, right? We all do it. I mean, it's not just you, it's everybody. It's professional portfolio managers feel the same way. Warren Buffett feels the same way. It's irrespective of who you are. It is human nature to do this because you look at it and you're like, yeah, I did that. It's like, great. Yeah, you kind of did that because you didn't move the price. You just got in the way of good prices. So I want you to look at your portfolio, and this time will be a little harder if you're in precious metals, but I want you to look there and take a clean slate look. I want you to look at it and say, if I were to invest today, where would I put my money? And if your answer is not those things you have in your portfolio, get rid of them. Okay. It's the end of the year. It's a great time to do tax loss selling. And I know everyone talks about that. It's good. It's not good, whatever. Tax loss selling, there's nothing bad that can come of that. But I want you to kind of look at your portfolio and say, would I buy into this stuff now? And look at it, if you had, let's say, silver, and this is not a recommendation at all. I want to repeat that again at the end too. If you had silver and it's up, whatever it's up, like 120% or whatever it is this year, the question is, should you sell some of it? Is the position too big, right? Or are you done? Are you just like, I'm done with silver, I want to get out? And, or I wouldn't buy it at these levels. Okay, maybe you should sell it. I'm not saying you should. I'm not, but I'm just saying that it's how you should look at it. If you own ABC stock and it's and it's like got a PE of 100, you might say, I would never buy it here. Great, maybe you should sell it. Right? That's how you should think about things. Also, if it's sold off a lot, or it's a dog, or it hasn't gone anywhere, and there's no catalyst for it to go anywhere, you might look at it and say, I wouldn't buy it here. Okay, get rid of it. Right? So it's a great time to do the portfolio hygiene and to edit what you have in your portfolio and decide whether it makes sense to keep it, add more. Add more is another option, right? Or add new position, but it's something to consider right now, this time of year. It's also a great time to assess your portfolio for your investor psychology. If your investor psychology is investing in CDs and you own a bunch of crypto and junior miners, well, maybe you should consider whether what you're doing is aligned with your psychology. Okay. And I think the important thing is that, all of us kind of get wrapped up into things throughout the year. You get excited. Hey, I got some silver. It's doing really well. Now I'm like 150% exposed to silver. Okay, maybe that's not a good idea, right? If you're not aligned that way. So it's really important to make sure that you're aligned with your investor psychology. If you're a day trader, you shouldn't be investing like Warren Buffett, right? If you're aligned like Warren Buffett, you shouldn't be trying to day trade, right? You need to align with your investor psychology. Do the things that are aligned with how your brain works. If you need action, God save you, because that's not a good trade for investing. That's a great trade for the casino. But that's not a great trade for investing. So, but if that's the case, find something that's a little more action oriented. So just make sure that's aligned. And, and finally, just do an analysis of your portfolio. How you did? Good, bad? Did you follow your rules? Did you have rules? Maybe you didn't have rules. Maybe your rule is I follow whatever's on Twitter today, or X. But whatever the rule is, make sure when you're investing you have rules. Make sure you follow those rules. And if you didn't, that's okay. But keep track of it and score yourself. Did I do a good job? Did I not do a good job? this year we looked at our portfolio and we're happy with the outcome, but we're also looking at what can we do better. What do we perceive is going to happen next year, and how do we align our tools with that? We use options a lot, so we're always looking at our tools. Like, what tools are we going to be using given the environment we're in? So these are all important things to consider. What do you need to be looking at for your portfolio, for the tools, for your investment positioning, for your psychology, and your analysis? All of these things are really important to do this year. Lastly, I also want to point out, we said this last week, this is obviously a great time to do tax loss selling. It's also a great time to be looking for year-end tax loss selling of everybody else. Everyone else tends to do tax loss selling in their dog positions, right? In their worst positions. If a position is down 80% this year, you might want to keep an eye on that. I'm not saying you buy today. I'm saying you keep an eye on it. So let me give you an example. Back in 2000 and let's see when it was. Was it 22? I always get these screwed up. Let's see. Let me look up Bitcoin. Maybe this isn't going to work out the way I wanted it. All right, here. Let me pull this up. All right, so I'm looking up Grayscale's GBTC. All right, so it's the end of 22. Okay, I was so long ago. It's 22. Anyways, the end of 22, Bitcoin, Ethereum bottomed out. Okay, it was literally December 31st was like the low point, and the first week of January it popped. And let me share the screen and. Silly. Sorry. I'm going to bore everybody with my hemming and hawing. Here we go. All right. So if you look here, right, this is 21, 22, the end of 22, it bottomed out. And then it started to rise. Well, why did it keep going down? And why did it change the first week of January? Well, here's why. Because it was year-end tax loss selling. People were trying to get out of their positions because, well, it lost a lot of money, so let me just get out. And then I can buy it back 30 days later, right? That's the idea of tax loss selling. You get out and then you get back in, right? So maybe you have a position in Apple hasn't done very well, so you sell it and you buy Microsoft as an example, right? Or you get out of British Tobacco and you buy Altria, right? But the tax loss selling idea is to get rid of your losses and then capitalize on them, and then you get into a new position of which you start January 1st. And sometimes, and this is the lesson here, sometimes if something just keeps going down, what ends up happening is January 1, people start to buy it because it's way below where it should be, right? And I thought so in this case, it was ETHE. So this is the one that I remember very, very vividly, because I remember, buying this. And look at this, went from 4 up to 8 in the matter of basically 2 weeks. I think it was 2-3 weeks. That was really quick. Of course, it took a long time to get back to way higher. But my point is if you're at the end of the year, you see this type of behavior, not in everything, but in some things. So I want you to start to think about what are the different things that you're considering getting into that have just totally been beaten up with a sack of pennies. And that's what you should be looking at right now. Are there positions that you want to buy that are totally beaten up, that are probably beaten up more so because the end of the year? And I'll bet if you do some scans, and those of you who don't do this, do some scans this time of year and just scan the whole market. Look at all sectors, look at as many stocks as you can, look at all international markets, look at commodities, figure out what's been doing well, what isn't. Because if there's a turning point, sometimes the turning point is the calendar year. So you'll probably see a lot of opportunities if you look at this. It doesn't happen every time. I'm not saying just because you own a stock, it's going to go the other way. I'm saying that if there are stocks that are looking for an excuse to turn around, this is a good excuse. Earnings are good excuses. January 1st, December 31st is a good excuse. All these are good excuses. So look for the excuses. The end of Q3 is also a great excuse. Happens every year. Hedge funds buy stuff and they need to turn their portfolio around. Also another one. So if you understand where these turning points are, these natural turning points in the market are, and you're waiting, it's a great time to be looking around saying, am I right? Am I wrong? Now, if after the first week of January, nothing's changed, okay, get out. I mean, if it's a falling knife, I'd probably ignore it. But if it's out, to buy it December 31st. If it doesn't go the other way, then sell it the next day. What do you have to lose? So you lose 1%. Okay, whatever. Right? You didn't make a big error. Don't sit around and wait forever. But my point is these are things you should be watching for. They're natural turning points. We don't know if the things are going down. We don't know when the market's going to change, but we know where there are natural turning points where it could. Okay, and that's one of the secrets. So that's the big takeaway for today: is make sure that you're looking for portfolio opportunities that you had considered, and maybe you're not considering enough, but you should consider now. So spend an hour, spend a few hours, and just look around. It's the end of the year. Even if you only make one trade a year, it's a good time to be doing this and look for opportunities of things you want to buy, but maybe beaten up. I don't have any live examples because I haven't done this process yet. I'm doing it next week, but just something to consider. So, what do you think, Doug? Where should we go next? We got a lot of big news.
Well, hold on. You loaded me up there. I got a couple thoughts on this. Okay. First of all, one of the things you talked about, you mentioned, like, obviously if something is falling, maybe it's a good time to get rid of it. Maybe if something is, you think it's gotten too expensive. There's a middle ground there too. For a lot of people, you might own something, you might have a sizable a portion of it. Listen, all the old adage of diversification, generally, to a degree works. It's effective of having more different things, but there is the argument sometimes it doesn't work that way. If Bill Gates hadn't listened to Warren Buffett, he'd be worth probably $400 billion, but he diversified, his Microsoft stock and reduced it. And now Steve Ballmer's worth a lot more than Bill Gates is. Granted, Bill Gates also gave a tremendous amount of his wealth away to his own charity. But sometimes it's not just cut what you have. It's also maybe if you're continuing to dollar cost average into it, maybe it's just one of those where you pull back on adding more if you think it's a little bit overpriced. But maybe you're not ready to sell it. Maybe you continue to hold on to what it is. And of course, if it's in a taxable portfolio, you talked about tax loss harvesting opportunities, but you also have to be aware of, paying the capital gains on those tax appreciations. So, and one problem with the fact that we've had, 4 years of, roughly 4 years in a row of S&P 500 growth, double-digit growth, is that there's not necessarily a lot of places where a lot of people can turn to find losses to offset gains. So, it's one of those things where sometimes you're going to have to consider ripping off the Band-Aid and making some decisions to maybe reduce some exposure, and it might hurt a little bit. If you've held it less than 12 months, then you're going to pay ordinary income taxes. If you're in a higher bracket, you're going to pay taxes on whatever money that tax generates. You're going to pay it as last money in at the highest bracket you're in. So some of you out there, you might be paying 33% tax on whatever sale, gains you make if it's less than 12 months. If it's over 12 months, then it could be 15, 20, 25%, depending on your tax bracket. But that if you don't have any losses to offset that could be a very painful move from a tax paying standpoint, but it still may be worth it from a risk standpoint. The other thing is, we are in a world now where we have crypto, and crypto is something that we didn't, really experience, having a major portion of holdings, for individuals, 5, 10, 15 years ago. But one thing for those of you to out there that might hold it, there is a difference between crypto ETFs, which are definitely the most accessible way to have cryptocurrencies in your portfolio, but maybe some of you out there listening actually are holding on to actual Ethereum, actual Bitcoin. Maybe you have a vault for them. Here's the one thing it is really important to know from a tax standpoint is that if you're going to sell right now, if you're going to deleverage a portfolio, you're going to take and you want to take some tax loss harvesting. There is something called a wash rule. And a wash rule means that if you sell something and you can claim that loss, you have to wait over 30 days to buy it back. Otherwise, the IRS considers it that you didn't sell it and you don't get to claim that loss. So even if you're holding something you think might be valuable in the future, but it's down right now, unless you think it's going to absolutely move, mountains in the next 30 days, you might decide to sell something you even like just to capture those losses right now, and then wait 30 days, buy it right back. And it's probably, chances are pretty good it's not going to move that much. Just wait for the 30 days. But here is one area where you don't have to do that, and that's crypto. Bitcoin, Ethereum, cryptocurrencies are not considered securities. They are currently coded as property, and property is not subject to the 30-day wash period, which means let's take a look at Bitcoin. Right now, it's back up to about 89,000, 90,000. It had dropped to, the mid 80s. At one point here, though, in the 52, week range, it was as low as 74,000. It was as high as 126 not that long ago. Some of you may have purchased Bitcoin at its highs, maybe well over 100,000. If it has pulled back right now, and it is now, if on what you purchased it at, you could sell it today, claim that loss, and buy it back immediately and have absolutely no issues with the wash sale. Now, if you have Bitcoin ETFs, totally different story. If it's been packaged as a security, you're going to have to wait for the 30-day wash period. But crypto, this is really important for those of you out there that own it, has a very different rule because it's categorized differently currently by our government. So that is something, again, we've seen a $40,000 shift in the price of Bitcoin. Ethereum's not that level, but percentage-wise, Ethereum has made some big moves. If you're holding on to that and you want to get some, maybe take advantage of some opportunities for tax loss harvesting there, that one, it's considered a current loophole. Who knows how long that'll last, but it certainly exists now. The other thing is just to remember from a tax standpoint, if you sell those losses. So let's say I buy something at 100, it's at 70, I sell it, I take a $30,000 loss. That is good into perpetuity. We can use that into any gains in the future, whether it's next year or 2 years. It's you kind of build a pile of these gains that you can use for future, of these losses you can use for future gains. However, not only can you use it against future gains, so if things pop back up in the future, now you've got these losses that you've harvested that you can use. But guess what? You can also capture $3,000 of those losses every year against income. So I get these questions all the time for people like, especially W-2 employees. We have a system in America that is built for business owners, entrepreneurs. Our tax codes are definitely more favorable for people that own businesses. W-2 employees carry the burden of our taxes. There's not a lot of deductions you can take. So one of the questions I constantly get from my clients is, where can I find some places to reduce some taxes? If harvest some losses, you can take $3,000 against your income every year until those losses are gone. That's one simple way that anybody could take advantage of it, and another reason you should be looking at tax loss harvesting if there's opportunity.
Yeah, great tips, Doug. I want to get into a few different topics here. So one of the things I want to talk about today is, you might imagine, gold and silver. Shocker, right? So I was doing a little research and came up with, I know one of the things we talked about in the show is why did gold and silver just take off this year? And especially gold. Gold was really the forerunner of this and really took off. And everything I've been hearing is central banks are buying it. That's really where it started. Central banks started to buy gold. But I actually found a framework that fits this. And just to be clear, you never know why things are happening. I know you read the news and they say, oh, it's because of this. No, it's not. No one knows why things are happening at all. There's only speculations of why things are happening. I remember in 2011, in April 15th, gold plunged. It broke through some support levels and plunged. And their news was, oh, it was a fat finger trade out of China. Or, oh, it's people selling to pay their taxes. The most ridiculous two things I've ever heard. No, neither one of those things were true. It didn't make sense at all. But that was the claim, right? But people don't feel comfortable. And here's the key: human beings don't feel comfortable without a reason. We need to know a reason why things are happening. Why is the sun going across the sky? Well, it's because there's a chariot of the gods pulling it. Back in those days, there was no science, or science wasn't where it is today, and they didn't know. So they came up with reasons. It doesn't mean if the reasons are true, but our brains are always trying to fill a void of unknown with a reason. And if that reason is totally ridiculous, doesn't matter. We're going to come up with it. So the same holds true for investing. And that's why I share that. Now, here's a framework that actually made sense to me. I don't know if it's true, but it makes sense. And if it does make sense, then you should really keep close watch of this. All right. So basically, Basel III, which is a framework that banks use, to dictate kind of risk in their balance sheets. And Basel III won't be completed until at least 2028. However, most of its provisions took effect in July. Okay. And here's one of the things. Basically, if the U.S. deficits breach 7.4% of GDP next year, which is the baseline estimate by rating agency Fitch, that the top 20 global commercial banks will start adding substantial amounts of physical gold as replacements for treasuries. Slowly at first, but it might speed up. Now, that was a speculation on this. Now, I'm going to pair this with another story, which is relevant, which is JP Morgan. Now, mind you, that this story was in the Economist of India, not in the U.S. It was out of India, the Economist. It was their tracking. It wasn't us that figured this out. So JP Morgan for years was a net short about 200 million ounces of silver for years. And people talked about it because it was suppressing the price of silver, right? And silver is one of those things that there's not enough of it, and yet the price is low. Anyway, JP Morgan was artificially suppressing the price of silver. That's the claim. That's the tinfoil hat claim. I'm going to put on my tinfoil hat for a minute and tell you that that all of the shorts, all of the people who are really pro Bitcoin, Bitcoin, pro silver, and were really for silver, claim that JP Morgan is artificially suppressing the price of silver, and they raise holy hell and just complain. Okay, it doesn't really matter what the reason is, because it's either causing an effect or it isn't, so it doesn't really matter. But if that was true, if that is artificially suppressing the price of silver, then what's happened will blow your mind. So between July and October of this year, they covered the shorts. Not only did they cover the shorts, but they added long 750 million ounces. So they went from negative 200 ounces, which means they were shorting it, assuming they were going to make money if it goes down, to another positive 750 million ounces. Well, there's a few problems with that. Well, good thing is, that's bullish for silver. Well, that may have already happened. I don't know, but it's bullish for silver. Okay. But here's the problem. A lot of people are beside themselves for how awesome and bullish that is. The Economic Times of India revealed this. We didn't. I don't know where they found it, but I guess what you would call it is investigative journalism, Doug. I don't know if we have that these days, because I don't see any of those, but it's good old investigative journalism. They found that out. But here's the thing. Yes, that's positive for the silver market. It means JP Morgan sees it's going up and they're going to take advantage. Yes, that's a good thing. However, here's the bad part, is that if they wanted to crash the silver market for one reason or another, they could just dump all that in the market and that would completely crash the silver market, because 750 million ounces is a huge position. If you thought 200 million was enough to suppress the price of silver, what do you think 750 million is going to do? Now, I would speculate that that kind of manipulation may or may not fly in this environment. I don't know that that's. I would think that if they're going to use that as a hammer to knock down the price of silver, I would think it's still a little early. Would it happen if it gets to 150, 200? Maybe, but I don't think it's going to happen yet. That's just my personal opinion. It's not an investment recommendation, but it does worry me a little bit that they have a position of that size when they were formerly suppressing, quote unquote, arguably, we'll say maybe suppressing the price of silver. I don't know if they were, but according to the silver bugs, that was the claim. So anyway, I wanted to share that because I thought it was really important. There is some backstory to. I'm always looking for reasons why this is happening. I'll bring up central bank gold holdings maybe next week because I didn't bring it up now. But that's also important speculation because you can see that they're clearly they're clearly acquiring gold. I also want to point out two other things. So we talked about we'll talk about this first. So one of the things that if you're buying precious metals, and I'm going to share this with you, if you're buying precious metals, you should always buy for weight. Don't buy rare coins that some guy told you, well, it'll be worth a lot because they're rare. No, buy for weight. You can't go wrong with weight. If you're an expert coin dealer, you can do whatever you want. But if you're just Joe and Susie Public that know nothing about gold other than, hey, it's on my ring finger when I got married, then you should be buying for weight, okay? You can't go wrong for weight because weight goes in the direction of the price. Weight is basically the lowest. So here's how gold works, okay? So gold, let's say it's trading for $4,400 an ounce, okay? Let's say that's the price. And if you're buying gold on the futures exchange, that's the price you're going to get it at, right? If you're buying an ETF, it's going to be some version of that, right? It's going to be basically pegged to the price of silver minus the expenses, right? And there's usually expenses in these ETFs. So the expenses, let's say it's 1%. Okay, so it's costing you 1% to hold that silver. Okay, but that's just what you sign up for, okay? Now, let's say you go buy physical silver. Well, if you go buy physical silver, you might say, well, it's great. I don't have the expense ratio. Yeah, but you got commissions. So the way it works is, well, actually, I've been pairing silver with gold prices. Let's go back to gold. Well, let me pair them both. So with gold, if you're buying gold, you're probably buying a $80 to $150 premium. Okay, that's the commission. So if you're buying it for $4,400, you're actually getting the coin for about $5,400, somewhere in that range. I'm sorry, $4,500, 45 to $4,600. I think of the prices I saw yesterday. So you're paying an extra $100, $150 an ounce. That's the commission. That's what we call the spread. You can't get it for spot. You cannot get it for spot because what happens is these dealers, they make that spread. They get it for close to spot, not even at spot. They get it for a little above spot. And then because the problem is if you're mining it for that, it costs money to mint, it costs money to transport, it costs money to sell. So that's all baked into that premium. So it's usually somewhere between 2.5, we'll call it 3 and 6% premium on gold. Silver can be as high as 20%. I don't know what it is today, but I know it was somewhere around $9 was the cheapest I found last night, but it certainly could have been higher. And you might think, well, that's a big premium. Okay, then don't buy silver. Buy an ETF, right? And that's what I do. I buy the ETFs because I don't want to buy the physical silver. It's too costly. You buy silver when no one wants it. Now, I bought silver when no one wanted it. The premiums are really skinny. But here's what I want to share. So this chart is what we call the $20 St. Gaudens MS64. Now, let me explain what this is. So St. Gaudens is basically, they call it double eagle. It's a beautifully designed U.S. gold coin, and a lot of people love it. But anyway, so they don't make these anymore. Okay, and what you want is you want to find, and the MS is basically the rating. So there's two coin rating agencies, as far as I'm aware. MS is one of them, and so the MS is basically the rating, 64, 65, 62, 63. The higher the number, the more perfect the rating. So I won't get into the rating, but I want you to understand this. These are what we call rare gold coins, okay? They're still U.S. sovereign minted coins. There's not like Joe's rare coin that he minted in his backyard. This is the U.S. government minted these, and they are rare. And frankly, there's not really. You're still buying it for weight, but here's how you understand the chart. So the blue line is the coin price, and the green line is the gold content. So it's basically spot price. So if you notice here between the blue and the green, there's a spread, right? This is the spread. It's wide. Sometimes it narrows. Like here, it was pretty narrow at the end of 2018. It's pretty narrow now. But if you look here, the red is actually the spread, the percentage spread. And if you look on the right, it's the percentage premium. So back in 2015, the premium got all the way up to like 55%, which is crazy. You would never overpay for that. Right now, it's about 9. It is as low as it's been in the last, what is that, 13 years? I don't know why. 15 years. Sorry, this is a 15-year chart. In the last 15 years, this is as low as it's been. Now, is it as low as it's always been in history? No, but this is really low. And the reason I point this out is that it makes sense to take advantage of this. And I'll tell you why. If you're buying for weight, then you're paying 9% premium over spot. Okay, well, you know, the premium over spot is probably 6, so you got a 3% spread. It's really small. Here's why it matters. Because if the price of gold goes up, the coin is still going to go up. If the price of gold goes down, the coin's going to go down. Here's the difference, is that at certain points in the market, people highly appraise these coins. And if they do, you could get a 50% spread. In this case, in the last 15 years, you could get a 50% spread over premium, which means if the price of gold is $5,000, then your coin is going to be worth $7,500. So here's how you arbitrage this. You want to buy coins like this when the spread is really historically low. I mean, really low. And this is, like I said, I don't know if it'll ever get to a normal coin, but your downside is limited. You have a 3% downside for being wrong in the spread. Now, your upside, according to the last 15 years, is 55%. So it doesn't matter where the price of gold goes. If the price of gold goes sideways for the next, 50 years, the spread can change. The spread, I don't think it could go down lower than 3%, because 3 to 6 is historically the spread on gold. So you're really looking at 3 to 6% downside. Your upside is basically 45%. So risk to reward, this is an excellent idea. Okay, and there's other ideas. This is just one example. That if you're into coins, you probably understand this. If you're not into coins, you maybe shouldn't do this. Okay, because there's complexity here. You have to understand a lot, and there's a lot of people who know a lot more than you, and they could take advantage of you. So I'm just saying, just be careful. Okay, but if you know a reputable person that you can work with, it can work. So this is an idea. I love ideas like this. This is an idea that you can practically implement. Is you buy it close to as low of a premium as possible over spot, and you wait. And you wait for the premium to be really high. And in this case, probably 30 to 50%, depending on where things go. See if you can take advantage of it. And so what you do is, let's say there's a 30, 40, let's say there's a 40% premium. Okay, that's the most recent high. Gets up to a 40% premium. Great. What do? You sell it and you buy back the Gold Eagles, which has a premium of like 3 to 6%. So you're basically capturing that spread, okay? And the higher the price of the gold goes, the higher the spread. And typically the spread is high when gold is high after it's rocketing. So you wait till it's popped, and then you sell it and you buy back the Gold Eagle, and you capture that spread, and you still have exposure to gold. So when the spread's high, you buy the weight, you buy basically the sovereign, the Gold Eagle, or the Buffalo, or the Maple Leaf, or whatever the lowest premium over spot is. And then when the spread's low, you buy something like this and you wait, and then you sell it. That's how you play the spreads. Wall Street does this all day. This is just a live example on gold coins, something that anyone can do with a little research. So I'm not recommending this. I'm just saying it's an idea that is really interesting to me that I've kind of looked at. It's hard for me to do this with clients, but because this is kind of outside the scope of of a lot of the securities. But we could do it. But anyway, just something to think about. I'm not recommending you do it once again because I'm getting in trouble if I do. But just something to think about is these are the kind of things you can look for. There's plenty of other coins out there that might do the same, and you can look at historical charts. But I want to share it just because it was so obviously one directional. Now this could keep going lower, but the downside's kind of limited. That's why I mentioned it. Anyway, all right, so we're going to go back to you, Doug. We can wrap it up, and yeah, where should we? What do you want to talk about before we wrap it up here, Doug? Before Christmas. I'm sorry.
Well,
one thing really quick.
Yeah, go ahead.
Hit. All right, so the last thing is we talked about this a few weeks ago. Is that if you look at the progression for precious metals, is gold goes first. That starts to take off first. Then silver, then the mining stocks, and then junior mining stocks. After precious metals, and I don't know where in the progression is, but after precious metals, you're looking at copper, steel, aluminum. These things pick up later. Now you're looking here, obviously they're starting to take off, right? You're starting to see that pick up. Copper stocks, steel stocks, aluminum stocks. I'd probably stick with copper or steel. Those to me seem, I don't know how aluminum operates. I'm not an expert in it. But if you're looking at inflation, if you're looking at metal inflation, which this progression shows, this would be something to consider. This would be an idea to stick in your stocking here for Christmas. I don't know how it plays out. The end of the year is coming, but I just wanted to share because we did share this a few weeks ago when it was at the line. Now it's taken off. Something to consider along with our other ideas we shared with a few weeks ago. Is inflation getting you down? Do you feel like your money is worth less every time you open your wallet? Is shrinkflation frustrating you at the grocery store? Well, I have an answer for you. We're giving away free money. That's right, I said it, free money. I feel like I'm not doing my part to create inflation. Why does the government get to have all the fun? What could be better at increasing inflation than giving away free money? No, I'm not an employee of the Federal Reserve. And no, I'm not an employee of the US government either. And no, I am definitely not printing it myself. But it's free. What more could you ask? Well, you might ask, is it real? Well, yes, it's totally real. I'm holding it in my hands right here, see? Oh, wait, this is a podcast. You can't see it. Either way, I'm holding it in my hands right now, and I want to give it to you. If you want some free money, go to moneytreepodcast.com/free money to get your free money today. Follow the instructions and I'll send some to you. Enjoy your free money today. I'm not the Federal Reserve, so I only have a limited supply. This offer is good until I run out. Go to www.moneytreepodcast.com/free money to get your free money today.
Well, yeah. No. So since you're on the gold and the silver precious metals thing, I thought you had a nice chart there. Like we call or we didn't call it, but silver bells are ringing. I think it's good to note that when we were talking about silver and gold several months ago, when we were talking about how it was lagging significantly over the rise and appreciation of gold. That silver was basically hovering in the $20 to $30 range, which it had been hovering at for most of the past 10 years prior to its major spike coming out of the Great Recession. When it kind of hit the $40 to $50 range. Since our conversation around this a couple months ago, Kirk, the March 2026 silver spot is up to $64. I mean, it is doubled. It is incredible growth, and you have a
69 today.
Thing. What'd you say?
69 today.
69. So that I was looking at. Yeah. So it keeps going, and you actually had some information about J.P. Morgan. Just kind of tells you, that we talked. You said this several months ago. I'm giving you credit for this. Is that it'll start to grow, and then if things pop, and then the real money comes in, right? You talked about being early, right? And this is where the early comes in because it's now up to 69. J.P. Morgan had been short silver for years to the tune of selling short around 200 million ounces. They've completely reversed this position now. So now again, being early paid off because between July and October, J.P. Morgan covered the shorts. It became clear that silver was solidly above that $35 level, but they did more than just buy back what they shorted. They now hold 750 million ounces at least. That makes them, the largest single owner. And they also have the actual metal, though a smaller part of this is still paper silver. Apparently, they bought more, adding 21 million more ounces since the end of October. The Economic Times of India had kind of had talked about this, but the question, it's also potentially worrisome if for any reason J.P. Morgan decides to sell any of it. But I don't know if we go back to The Big Short, and if anybody's watched that movie, great movie. If we know what happened, people that have followed what the story of the mortgage-backed securities in 2007, 2008 is what they found then, and this was Morgan Stanley. Morgan Stanley's internal team was trying to short these because they saw a problem, and guess what was happening? The company itself was betting against them because they had so much at stake. So yes, is it possible that JP Morgan could decide to reverse and sell any of it? The answer is possibly yes, and at higher prices, it could be advantageous for them to do so. But at the same time, it's also something in which their own vested stake, if they try to sell too much of it, they could actually lower the price and hurt themselves. So they will, it puts them in a tough position to actually unload that much, which is probably, yes, it has some, some risk, but it's also, in a way bullish for the price of silver to remain because they're not going to want to dump the price and basically undermine themselves. I want to transition a little bit here just about inflation in a couple of areas. I had a chart that I found, I think, that was posted about inflation, and I think, and kind of where it's been. One of the greatest indicators of inflation that was posted by a group called Political Calculations is the Campbell's condensed soup can. Now, we can argue about what's actually being, the ingredients in Campbell's soup, because there was some controversy that came out recently where one of the VPs basically said they're putting garbage in there. But the one thing that hasn't changed with it is they have not changed their sizing. One of the things we're dealing with, and I'm going to jump to this after this, is we're dealing with something called shrinkflation. You can go back, you can take a look at the price. Some say, hey, the price is the same, but realize that the bottle or the case of it is much smaller than it used to be. So you're getting less for the price, and they're just getting you to stay within budget, but you're going to have to go back and buy more of it. Campbell's soup cans haven't changed their size. So it is arguably a very quality indicator of true inflation because the can itself has remained the same, which means what's happened to the price. You can see here that the price, unit price per can from 1897 all the way to 1974 was pretty much fixed at about 10 cents unit price per can. Look what's happened since 1975. We saw a massive rise in the price per can starting at that point, which then, of course, has shot up recently since 2020. I don't know, again, Kirk, we've talked about this before. What happened in the early 70s? Anyway, there's definitely
I don't remember, Doug.
gold standard. What'd you say?
I said, I don't know, Doug. I wasn't around back then,
I wasn't around back then, so we have lived this inflation ever since. But for those that argue that going off the gold standard had a impact on inflation, more and more charts like this seem to indicate that, hey, I again don't know if it's correlated or causative, but it's definitely correlated. So just kind of a look at it. We're now up to, since 1970, we've gone, I don't know, that's how many thousands of percent increase, but literally just since 2020, we have seen the price, we've seen almost a 30% rise in just the cost of that. So we're definitely facing that. And then if we jump ahead to some other indicators, I pulled a chart what Gen Z is facing. They are definitely spending more on essentials than previous generations. There's a chart from 1985 to about 2024, give or take, from the Bureau of Labor Statistics. Ironically, food is not one of the things that they're actually paying that much more for on the Bureau's chart. You could see, this chart that I had shows that real wages have gone up since around 1985, about 30%, and food itself has gone up about 30% too. Now, again, we know that where they're manipulating those numbers, what kind of food that they're using. There's a lot of extra data that goes into this. But what is a fact is that housing, vehicle insurance, and other things have spiked tremendously. You're looking at vehicle insurance over that time being up over 140%, housing over 115%. None of this is a surprise to anybody that things have gotten absolutely more expensive. And I also wanted to, kind of look at, again, if we were to take a look at, again, inflation. We take a look at, I'm jumping around a little bit. If we want to take a look at the impact of shrinkflation, I actually have a chart here talking about the cost of new homes. Lennar, I don't know how you exactly pronounce them. Their new home price has actually been declining since 2022. The pandemic peak, their average home price was $491,000. It is now down to about $383,000. So we should all just celebrate, pop champagne. The price of homes are going down. Again, what we're also seeing is that the size of homes are going down. If you've seen any kind of any articles that have come out about some of the new communities that they're building, these homes that they're stacking in, smaller lots, condensed. They almost look like townhomes, but they're single family homes. So once again, look at, be careful what you read through the data. There's, because shrinkflation is a way of manipulating the information you're seeing to where something looks like it's holding in price value or it's going down in price value. But what you're still getting is that the price per unit is significantly higher than it was before. So you're going to get a lot less. And it's probably going to be hard to argue that we're not going to see a continued trend of this. So get the tiny home, I don't know. There were shows on HGTV about tiny homes, and it was kind of one of those things that was kind of funny to watch. If people would be willing to get into these basically boxes that look like the shed I have in my backyard. Well, this might be more reality than fiction as we continue to go forward in terms of affordability. There's some more things to get into.
We gotta wrap it up here, Doug, in the interest of time. So
yeah, exactly. So As I was going to say, there's more things I'll get into, but I'll save those for another week, and just kind of close it up here with a couple of thoughts that basically we are in a situation right now where we are facing a tremendous amount of cost. We are facing a lot of things at the end of the year that we are it's time to reflect. It's time to take a look at the what you have and your valuations and kind of research things and just make sure that before the end of the year that there's anything that you can adjust or need to adjust. Remember that once that clock turns on December 31st, you're not going to be able to take advantage of any tax loss harvesting or any opportunities there that you had before. So you want to make sure that over the next, if you're taking some time off, that there's going to be an opportunity for you to look at this and maybe make some decisions. But and again, if you're working with someone, they're going to probably be going on vacation too. So you're getting a lot closer to a time in which you're going to have less opportunity to look at this stuff. Things have gotten more. Some things have appreciated, like precious metals. Other things in your portfolio have declined. And the reality is if you're just kind of floating along and you've got stuff in all these different places and you don't have it tied together where you're looking at kind of how it's integrated, how it's working, where your cash flows are, where your assets are. And again, if something happened to you tomorrow, where would your family also turn to know where things are as well? One thing I find when I work with families is, money conversations are still something that most families are lacking to the degree of full transparency. And it's not because it's willful. It's because, a lot of times someone's responsible for one thing, maybe they're responsible for the money and the other one isn't, or they're working, and they're just moving in different directions and you've got kids. So again, sometimes, to take a step back, if you haven't mapped that out, if you haven't really seen where things are and built something that's going to put everybody on the same plate, maybe this is a good time to revisit this. You can do this on your own, or maybe it's a good time to get some help on how to do this so that you can make sure that you're working with a plan and not just hope. If you want some more information about that, go visit us on our website. My company is Mergent Advisors. It's Mergent, Mergent Advisors, Mergent, mergentadvisors.net. You can also learn about our college planning services, which is something is very unique in the way we plan, because this is a major source of fleecing of wealth for affluent families. Go check it out. And if you have any questions, please don't hesitate to reach out.
Awesome. Well, thanks for coming on, Doug. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name is Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.